Silver's now in that position, and the miners as well, to really launch in a way on a percentage basis much more than gold. And again, if we use that eightfold model, and I'm not going to predict, I'm just going to say it did it 3 times before, far better justification this time, then go $8,000 gold. And that's just doing what they did then. Now you look at the ratio of silver to gold, that's the other issue. If you go back, now we measure it differently than most people. We just simply divide the price of silver into gold, and right now silver is about 1.2% of the price of gold. Okay, pretty low. If you go back over the 50-year period, you'll see numerous times, handful of times, where silver has gone up to 2.5 to 3% of the price of gold. So it's not like it's extraordinary for it to do that.
Silver price gains may be dull compared to gold's glistening returns over the past year. But since the start of this month, the gray metal has added 12% compared to gold's 5% gain as investors seek an alternative asset to take advantage of a resilient economy, protect against heightened geopolitical risks, and guard against elevated inflation. MichaelOliver is an expert in momentum structural analysis and is renowned for his insightful perspectives on financial markets. While refraining from specific predictions, Michael mentions the potential for significant upward movement in precious metals based on historical patterns. He states the potential for silver and mining stocks to outperform gold, especially in the late stages of the bull market. Silver has a long-standing track record of outperforming gold in bull and underperforming bear markets. This high beta comes from silver's smaller market, which makes it more volatile. If gold embarks on a new bull run in 2024, history says silver will potentially notch even higher returns. Based on recent breakout patterns, Michael suggests that gold and silver could experience substantial gains in the next 6 months. He delves into the silver-to-gold price ratio, implying that silver's current undervaluation compared to gold could lead to significant gains if historical trends repeat. Silver also stacks up attractively when looking at the gold-silver ratio. Currently, 1 ounce of gold buys investors roughly 83 ounces of silver. That compares to the 30-year average of around 67 ounces. Now, we present the clips of MichaelOliver's insights from his recent interview with Silver Bullion TV. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Gold bull trend right now is about 8 years old. It started from the 2015 low, so it's got some maturity to it, but it's only doubled plus. Okay, and as you've noted, over the last 50 years, we've had 7-fold and 2 8-fold moves. And we have the background technicals and fundamentals now that would justify at least that much, if not more. But if you go back and examine those bull markets, you'll find that much of the explosion came in the tail end of the bull markets, the last year of the bull markets. I think we're now at that point. We've crossed enough what we call annual momentum technicals. We plot price like everybody else does, but we plot price in its relationship to, for example, a 3-year average or 36-month average to get a long-term vista of the momentum. And we get a totally different picture than when you look at a price chart. We just broke out of a massive multi-year horizontal range that's evident both on the miners. They've been going down in price the last 3 years, remember. Silver, which has been eroding for the last 3 years, not collapsing, just eroding from $30 down to, but it had a flat structure as well on its annual momentum, and gold did too. They've all broken out. When this happened before, and there's a couple prior times in history where we can look back and see that technical event occurred, it was usually at the tail end of the bull market or at the very outset of the bull market, not in the middle. And when you cross that threshold on momentum, you launched. And usually the launch would last a couple quarters, 5 to 7 months. And it was explosive. And particularly, it was explosive for the miners and for silver, where over the years of the bull market, they were keeping up with gold, basically, or lagging it a bit, but not dynamic compared to gold. In the last year of the bull market, they went berserk, especially silver. Go back and look at 1979 charts of silver and compare it to gold, what they did percent-wise. I think silver's now in that position, and the miners as well, to really launch in a way on a percentage basis much more than gold. And again, if we use that 8-fold model, and I'm not going to predict, I'm just going to say it did it 3 times before, and we've got far better justification this time, then go $8,000 gold. Okay, and that's just doing what they did then. Now you look at the ratio of silver to gold. That's the other issue. If you go back, and we measure it differently than most people, we just simply divide the price of silver into gold, and right now silver is about 1.2% of the price of gold. Okay, pretty low. If you go back over the 50-year period, you'll see numerous times, handful of times, where silver has gone up to 2.5 to 3% of the price of gold. So it's not like it's extraordinary for it to do that. Right now, silver is vastly undervalued. If it went up to 2 to 2.5% of the price of gold, and you had gold at $8,000, you do the math. Silver's a couple hundred. Even if gold only went to 4,000 and silver went up to 2.5% or 2% of the price of gold, it would be massive in terms of the percentage gain of silver versus gold. And we think the technicals have now shifted, favoring that outcome. And so I think the next 6 months, it's going to be seatbelt time. And I strongly suspect you'll start to hear in the other markets, like the stock market, central bank policy changes, et cetera, where you say, aha, they knew it was coming. Gold and silver knew it was coming. Massive flow of liquidity again.
During the interview, MichaelOliver anticipated that the Fed, under pressure to protect paper assets, will likely return to loose monetary policies. This shift is expected to create a favorable environment for gold prices as a hedge against currency devaluation. Holding fiat currency is risky, and that will stay the same for a while. Currency risk is one of the factors driving the recent rally in gold and silver. It's no coincidence that the recent gold and silver rally started as the U.S. ramped up threats to seize Russian dollar assets. Despite its current trading position in the 103s on the dollar index, Oliver pointed out its potential susceptibility to a 3% drop, which could cascade into a major decline below 100. He further stated that there have been 2 significant declines in the dollar index over the past 4 decades, suggesting that a third one may be imminent. The dollar began to fall in the middle of last year. After reaching a more than 10-year high in 2022 that saw it rise by nearly 50% from the 2011 low, the dollar has retraced about 10% from its peak. It is still higher than its 5-year average. The key driver of the dollar's direction should be monetary policy. In 2024, central banks worldwide are poised to cut interest rates. Among the major developed markets, the Federal Reserve is expected to lead the rate-cutting trend. Consequently, the dollar will likely continue to fall moderately as the yield differences between the U.S. and other countries shrink. Let's get back to the interview.
I wouldn't look at any currency. Yes, they compete with each other, and the dollar is up versus the euro, and therefore recently the dollar index has been up. The dollar index is a meaningless concept. It's 57.6% euro. It's hardly an index. Okay, it's a euro inverted. Okay, it's the degradation of the money units in general. And if you look at an M2 chart of the on the Federal Reserve site in St. Louis, go back 50 years or so, basically every decade, the money supply almost doubles. Regardless of the decade, regardless what happened that decade, the money supply basically doubles every decade. What does that mean? It means your buying power, gets wiped out every decade. So if you bought a stock at $10 and 10 years later it's at 20 and you think you're making money, no, you're not. Okay. When I was a little kid, a loaf of bread was under 20 cents. What is it now? Okay, so it's a ongoing degradation of money. But I think what gold sees here, and what it's done over the since it was legalized in the U.S., it went from 30 something to 200, then to 850, then to 1920, and now we're 2350. Why does it keep going up? Because money continues to degrade. But the question now is, if you break that bubble, paper asset bubble that we just talked about, the Fed will panic. They may say, oh, we're out fighting inflation. Well, they're going to have a real problem there because, yes, the Bloomberg Commodity Index, for example, is starting to reassert itself again. And I think we're starting a second leg up in commodities. So presumably the Fed would therefore do what? Maintain higher rates, not cut. Of course, the stock market doesn't want that. But if the stock market starts to break, there's the other thing that the Fed has, the other mandate, and that's employment. And employment numbers, frankly, have not looked good. All the last 3 or 4 months, they keep showing these, job growth is great, but it really isn't. It's part-time. It's in healthcare and home care services. It's in hospitality, and it's especially in government hiring. So all the main sectors of the economy are flat to down in terms of employment. So it's really but once that data point changes, the Fed will be pressured 2 different directions. And I almost guarantee you, they'll panic to defend the paper assets. In which case, what does that mean? That means any tightness we may have seen over the last since March of 2022 is gone. They're going back to loose policy. That's what gold lives on, and gold knows it's coming. The dollar does look vulnerable to us technically. Right now it's trading around just under 10. It's in the 103s, dollar index now. Again, that's a distorted index. It's the euro upside down. Okay. It looks technically vulnerable such that if you drop about 3% or so, you get back under 100 again. It could cascade to the downside in a major way. Now, we've had since over the last 40 years or so, two major declines in the dollar index. I think the third one's about to begin. And once it begins, that'll become another variable. But for example, since 2015, when gold made its low, the dollar index has actually risen about 4%. So you'd think if you look at the dollar, well, how can gold go up? Gold's more than doubled. The dollar index is actually up. It was trading at 98 and change. It's now 103 and change. Okay, that's since December of 2015. But it looks to us like it could become a dynamic variable now, if it breaks these momentum structures that we're looking at, such that it suddenly starts to become a game player. Whereas the last 10 to 8 or 9 years, it's been this type of action. It could become dynamic, and then it becomes another variable in the mix.
Analysts attribute the significant surge in gold and silver prices to escalating geopolitical tensions, particularly in the Middle East. Simultaneously, investors are turning to these precious metals to safeguard against the persistent threat of inflation, aiming to preserve their purchasing power. How do you plan to adapt your investment strategy to the anticipated shifts in global monetary policies and currency valuations? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.